Markets flicker at dusk, unease builds across a nervous skyline. What if I told you that the world's biggest money manager, BlackRock, with over $10 trillion under management, just lost everything on a private loan? Not a dip, not a markdown, a total wipeout, gone. And here's the kicker, they didn't even see it coming. This wasn't some rogue trader pressing the wrong button or a random bet gone bad. This is a red alert moment, a sign that what we think are safe investments might be built on quicksand. Because just 1 month before this disaster, BlackRock called this loan 100% safe. And then boom, overnight, it was worth zero. Today we're breaking down the shocking BlackRock bombshell that could be the first domino in a corporate debt meltdown that might torch jobs, freeze credit, and flip the entire stock market upside down. So buckle up, because the nightmare BlackRock missed could be hiding right inside your own investments. How BlackRock, the giant, got blindsided step by step. So here's how this financial horror story unfolded. BlackRock made a $150 million private credit loan to a company called Renovo Home Partners, a home improvement outfit trying to survive in a collapsing housing market. At first everything looked fine. BlackRock labeled the loan as pristine, worth 100 cents on the dollar. They even locked it in as bulletproof. Then, out of nowhere, Renovo filed for Chapter 11 bankruptcy. That safe loan, gone. A 100% loss, wiped from BlackRock's books overnight. And here's what's terrifying. Renovo didn't collapse because of fraud or mismanagement. There were no shady accounting tricks or scandals. This was pure economic reality. Renovo simply couldn't survive the slowdown. Housing demand dried up, costs skyrocketed, and cash stopped flowing. And that means if a blue-chip firm like BlackRock can't see a collapse like this coming, how many more ticking time bombs are out there? Inside the ballooning private credit bubble few can see. Here's where things get even darker. BlackRock isn't alone. There's $1.7 trillion locked in private credit around the world, sitting in ETFs, mutual funds, pensions, and bank portfolios. These loans aren't publicly traded. They're opaque, rarely audited, and valued based on whatever the lender thinks they're worth. In other words, if the economy slows or one borrower collapses, those valuations can vanish overnight. And right now, that's exactly what's happening. Liquidity, the oxygen of the financial system, is drying up. Every bankruptcy pulls more of it out of the system, and that sets up the next domino, a credit freeze. We've seen this movie before. It starts small, a single company defaults, then a few banks tighten lending. Before you know it, businesses can't borrow, layoffs begin, and panic spreads. The data that proves tightening credit, rising delinquencies, and accelerating defaults across the system. Just look at the numbers. Data from the Federal Reserve shows a spike in banks tightening their lending standards for commercial loans, the biggest jump since 2020. Why? Because delinquencies are rising. When borrowers start missing payments, those delinquencies quickly snowball into defaults. And once defaults rise, banks panic. They stop lending altogether. That's exactly what's happening right now. Banks are terrified there's another Renovo hiding in their portfolios, another company marked safe that's about to blow up. This isn't a one-off, this is systemic risk. The global domino effect, slowdowns, layoffs, and debt stress cascading from factories to banks worldwide. But the crisis doesn't stop with the US. Over in China, passenger car sales dropped for the first time in over a year, down nearly 1% in October. And that small decline hides something massive: overcapacity. Factories are running full steam, but people aren't buying. The government stimulus programs are fading and demand is collapsing. Sound familiar? It's the same story as Renovo. Companies borrowed billions on the promise of endless growth. That growth vanished. Now, the debt's coming due. From real estate to autos, the world's manufacturing engines are seizing up. And as factories slow down, jobs disappear. When factories sit idle, workers get laid off. And when unemployment rises, consumer demand collapses even further, feeding a vicious cycle. The US fallout, imports plunging, margins squeezed, credit tightening, and small businesses on the brink. Now let's talk about what's coming for the US economy. Imports, the lifeblood of American consumption, are projected to plunge through 2026. That's bad news for everyone. Manufacturers, retailers, logistics companies, and small businesses. See, most small and mid-sized businesses borrowed heavily to cover higher import costs from tariffs and supply chain shocks. Many of these loans carry interest rates above 25% and weekly repayment schedules, so if sales slow down even slightly, these businesses run out of cash fast. Best case, layoffs. Worst case, bankruptcy. And every bankruptcy takes another chunk out of the banking system, just like Renovo did to BlackRock. Inventory crisis, the next trigger hiding on overloaded shelves. Another red flag? Inventory. Right now, American retailers are drowning in unsold products. Why? Because consumers are pulling back, cutting spending, skipping big-ticket purchases, and saving what little they can. That means stores are being forced to slash prices, with discounts reaching 20% or more across major categories. And here's the nightmare scenario. All that unsold inventory, it's been borrowed against. From the moment goods are manufactured to the moment they hit store shelves, someone has taken out a loan on them. If those goods don't sell, the collateral collapses in value. And just like Renovo's loan, those debts can go to zero overnight. That's not just disinflation, that's deflation. And deflation destroys everything it touches: profits, jobs, and the credit markets that fuel them. Why this is only beginning: leverage, liquidity stress, and fear. So, what happened with BlackRock isn't an isolated case, it's a flare gun, a warning that the entire corporate debt bubble is cracking. First it was Renovo, before that, we had First Republic and other banks quietly collapsing under bad debt. Now the next wave is forming, in small businesses, in manufacturing, in autos, in housing. And here's the scary truth. The credit markets are so leveraged, one spark could ignite a global chain reaction. We're already seeing cracks in consumer confidence. University of Michigan data shows sentiment sinking fast. People aren't just worried, they're scared. And when consumers pull back, companies stop hiring, sales plunge, and more loans go bad. That's the doom loop, and we're already in it. What you should do now: practical steps to protect yourself. So what can you do right now to protect yourself? Step 1. Audit your investments. If you hold mutual funds, ETFs, or pensions with exposure to private credit or high-yield loans, find out exactly what's inside them. Step 2. Rotate out of high-risk debt holdings while you still can. Liquidity vanishes fast in a crisis. Step 3. Diversify, not just across assets, but across geographies. The global slowdown will hit sectors unevenly. And remember, when everyone says, "This time is different," that's your cue to be cautious. Final takeaway: what BlackRock's miss reveals about systemic fragility. BlackRock's Renovo disaster isn't just a bad loan, it's a symbol of how fragile this entire system has become, a system built on debt, leverage, and blind confidence. For years, companies borrowed as if growth would never end. Now, the bill is due, and as these loans go bad, as businesses fold, and as investors realize their safe bets are anything but, the illusion of stability will shatter. So be alert, be skeptical, and above all, be prepared. Because the next big financial crisis might not start on Wall Street, it might start in the shadows with one safe loan going to zero, again. Stay ahead of shocks, like, subscribe, comment, and share for timely updates. If you found this breakdown helpful and want to stay ahead of the next major financial shock, make sure to hit that like button, subscribe, and drop a comment below letting me know, do you think we're heading for another 2008-style collapse? Or can the Fed and Wall Street keep this debt bubble afloat a little longer? Your insights matter, and they help this channel grow. I'll see you in the next one. Stay sharp, stay informed, and protect your money.